Can the US dollar really get too valuable? Now, that's something that I kind of want to ponder as we talk through this podcast today, because what we're going to talk about is strong versus weak currencies, whether it's good to have a strong one, a weaker one. And then we'll finally get into, hey, what does it mean when you've got directionality to that? Are you strengthening? Are you weakening? What are the takeaways? I think a lot of this has popped up given the tariffs, given, the kind of re-domestication of a lot of supply chains, and something that I think is worth discussing.
Currency valuation is one of those things that doesn't get a lot of attention most of the time. It's not a very fun topic a lot of the times, but it drives so much of global commerce and just geopolitics in general. And it's really kind of stepped into the limelight after the announcement of tariffs on a lot of U.S. trading partners, because there are talks about, not only what is that going to do to the U.S. dollar relative to other currencies, but also what are the advantages and disadvantages of having a consistently strong dollar. The U.S. dollar is a strong currency and has been traditionally, and the U.S. even has a strong dollar policy where they're not going to devalue the dollar in other, aims like we see other countries doing. We'll talk about that later. And that's part of why it's popped up so much, is that some countries intentionally keep their, currency strong, like the US. Other countries like China over time have artificially weakened their currency for their own reasons. So it's an interesting thing to look at, and lots of dynamics at play, but it really has such a huge impact on, our everyday lives, because US dollars are what we use to transact. It's what we make at our jobs. It's, it really covers all of our lives, whether we want it to or not. We're all tied to this concept that is so hard for anyone to control. And, even those at the very top of it.
Right. And the US has maintained that global reserve currency status for quite some time now. We'll go back to the point that the US makes up about a quarter of world GDP. Probably, at least 50% or over half of global capital markets. So it makes sense that most global transactions happen in US dollars. And that's the fascinating part about it. You can even have countries like China trading with South America, and a lot of times that will be denominated in US dollars because it is a very stable currency. You're not having to worry about FX shifts so much. And a lot of financial products are, of course, tied to US dollars. And so it makes for a good currency as far as what you're going to base various derivatives, trade, things that are important to global commerce on that US dollar. And it's been important that it has maintained that strength because a lot of foreign countries hold US dollars in their treasuries. Because when you think of a nation's treasury, what they want is to hold something that's going to maintain its value. That's why a lot of countries maintain huge quantities of gold, is because they believe that it's going to maintain, at least some level of fundamental value that's not going to change too much. If something happens with their domestic currency, at least they can kind of fall back on that to some extent. Well, a lot of foreign countries also hold, huge amounts of US dollars, whether that's in cash or US treasuries. And that's benefited them from the fact that the US dollar has, really strengthened throughout history. It's provided good returns as far as treasuries go. The US has not ever defaulted on its debt. And, that's continued. And because people have so much trust in the US dollar and the US government paying back its debt, it's maintained that global reserve currency status, and is something that has, fundamentally benefited the United States to this day.
Yeah. And in addition to just holding it because it's stable and consistent, things that are very important in currencies in general, but especially something you're holding as a reserve currency. Like you mentioned, they're also holding US dollars in order to transact on global markets. You made the example of, if China is trading with Brazil, that might be denominated in US dollars because the Brazilians might not want to be holding Chinese currency because, like I mentioned before, China intentionally has devalued their currency over time to make them more competitive in the international export market. So we'll get to that a little bit later, but China's kept their price down. The Chinese might not want to hold Brazilian reals because, Brazil is a smaller country and China wants something that it can use in other transactions with other countries. So they might transact that in American dollars. And that means that both countries need to hold levels of American dollars to facilitate that trade. Just one more example is that global oil markets, even those in the Middle East, are denominated in US dollars. There's been some talk about direct trade from, the Middle East to China, maybe denominating that in something else. But, over time, it's always fallen back to the US dollar because it's that stable reserve currency that can be used across the world without any major issues. And one important thing about the dollar that makes it truly unique from other currencies in the world is that it has maintained a strong, FX, foreign exchange rate to other currencies, despite the US consistently running trade deficits. And so, Economics 101, when you have high trade deficits, generally your currency will depreciate and those deficits will even back out into equilibrium. Like most things in economics, it all goes back to reaching an equilibrium state to where your exports and imports roughly match with the value of your currency on the international market. The US dollar has not done that. Mainly, it's a lot of factors moving on, but mainly because they're a reserve currency and they're going to be held for different reasons. They're going to be transacted differently than traditional, anyone else's currency.
Yeah, and I think that's an important transition point. What you just said is because with all this discussion of trade right now, tariffs, trade, rejigging the national or international supply chain, is that the US dollar year to date has declined about almost 8%, somewhere around 7.5% range. And that's a lot with, kind of the confusion about whether there will be the same level of trade with the United States as the US kind of pulling back from that. Of course, Donald Trump and the Trump administration are trying to push more exports from the United States. And that kind of requires a weaker currency. So you're in this difficult space where you benefit from a strong currency. I'd say it's probably a net benefit to maintain a strong currency. But if you want to push greater exports from the United States, you were just mentioning, balancing those trade deficits. It's going to become, and this will get into, the pros and cons of a weak versus strong currency that we'll get into, but it's beneficial to have that weaker currency in order to make your goods relatively more attractive. Because if yesterday, it cost someone in Europe, one euro was equal to the amount of goods that they wanted to get, well, maybe they can get 50% more goods for that same 1 euro or something like that. So it becomes, more attractive if other foreign currencies appreciate compared to the US dollar. And it's also comes at an interesting time talking about, currency strength, because you've seen throughout history different, international administrations or groups try to kind of unseat the US dollar in terms of that global reserve currency status. You were just talking about trade being denominated in US dollars, oil being denominated in US dollars. And a lot of countries have tried, but I think because of the size and scope of the United States and, our capital markets, it hasn't shifted yet. Even most recently, I just saw a headline that China is really pushing the yuan to be used more in trade, just, trying to establish their currency as more of a reserve currency. And so I think you're going to have these ongoing threats against the US dollar. But unless we really pull back from the world stage to, some huge extent, I don't really see our global reserve currency status going away anytime soon.
Yeah. And, like you mentioned, over time, there have been many instances where other countries have tried to, upseat the US dollar as a global reserve currency, use the Chinese yuan in this instance. But it's really hard to do whenever, like you mentioned at the top of the episode, the US GDP is a quarter of the world's. Our economy is the size of number 2 through number 4 combined. That's China, Germany, Japan combined. Their economies equal our economy. So no one's really that close in size or scope to the US economy, let alone with, the relatively consistent political structure that ensures a stable currency going forwards like the US. There are a lot of factors that go into it besides just sheer economic size, but no one can really touch the US in either of those respects. So while there might be some offshoots of it, again, like Saudi Arabian oil going to China, denominated yuan, something like that. But as a global reserve currency, I don't see the US going away. And that's been something that the administration's been talking about. Is there have been some gripes with, like you said, it's a net benefit to have a strong dollar, strong, global reserve currency. But there have been some gripes with some burdens that come along with it. And so that's part of why we're talking about all of this, is there some, undercurrents of changing that dynamic that we've been living with for the past 50 years. And we still have that strong dollar policy I spoke about earlier, but it's something to be aware of and consider.
Yeah, so that leads us to the question of the day, and that is it better to have a weak or a strong currency? And obviously that is a very loaded question, and it kind of depends. So I'll give it that answer, off the bat, is it depends, a classic business school answer, because it really does matter on what the makeup of your economy is, where you fall in the world order. I'd say for the US, it's certainly a net benefit to have relative strength. Now that comes within bands because you don't want to get too strong and you don't want to get too weak. But I think, having relative strength is valuable. And why don't we kind of start getting into some of the benefits, at least, of having a stronger currency?
So that's, great lead in, because there are a lot of benefits to this. And probably the biggest one that we see, published, and the biggest one to the US government, especially now, is that it lowers our borrowing costs. When there's foreign demand for US treasuries and just US debt in general, then the US can issue more of it and be more debt burdened without paying a premium to, compensate for the risk of default. Because if we can sell debt to anybody and everyone in the world and they'll buy it, it's going to be cheaper. So it lowers borrowing costs not only for the federal government to fund, government programs, but also that trickles down into lower mortgage prices for US home owners, home buyers, and, all the way down to even credit card fees in theory. So lowering borrowing costs is a huge one for the US, especially when we're at such a high debt to GDP level as we are now. Those lower borrowing costs are very important.
Yeah, I think that's a really good point, because there's been a lot of conversations recently about international players stepping back from US treasuries, which of course would result in an uplift in rates. We've kind of dug into that in some of our other podcasts to a greater extent, but having that international demand does make borrowing across the board cheaper, which is, of course, very attractive. Now, getting into another benefit is imports are cheaper if you have a stronger currency. So if our currency is strong, there's a lot of demand for it. That means that we can, on a relative basis, buy more international goods. Of course, we've seen that with the US, running a huge trade deficit with countries from around the world. We're buying cheap goods out of Asia, India. We've got good trading partners in the European Union and Japan. And having a strong currency means that we can buy more of those goods for the same number of dollars. And it keeps inflation from running too hot, because if you have a stronger currency, especially if your currency is strengthening to some extent, those goods on a relative basis are cheaper or cheapening. And so it really prevents, especially in a time when we're talking a lot about where inflation is and where it's going, kind of is helpful to have a stronger currency. And that's something that's going to be interesting when we talk again about the year-to-date move in the dollar of, hey, how does that trickle into inflation? Because now when we're sourcing these goods and then tariffs on top of that, how does that play into the inflation picture when we're still buying a lot of goods internationally, but our dollar isn't quite worth as much.
Absolutely. And then moving on to the final pro that we're going to list here, there are a bunch, but final big one being cheaper international travel. And so whenever your dollar or your currency is stronger than someone else's currency, you feel very wealthy being in their country. And so we've seen international travel drop off a decent amount to and from the US post the announcement of tariffs. A lot of that is just between the US and Canada because, there's some tensions there. But also, like we mentioned earlier, the US dollar has devalued almost 8% since the start of the year, meaning that if we're going to go to any foreign country, you're about on average 8% more expensive to go there. And, that's basically a tariff in and of itself. You're almost to that 10% level. So, that's a big change in spending power in foreign markets. And so when you have a stronger currency, you have relatively cheaper international travel.
Absolutely. Now let's talk about the other side of the coin. Maybe some pros when it comes to a weaker currency. And I think we already kind of touched on this, but most notably, your exports, what you're sending to other countries, become cheaper for them to purchase, which means that demand is going to be greater, and so you're able to sell more products outside of the United States. And that's what we haven't seen a lot in our modern day economy. The administration is really focused on, domesticating supply chains, improving manufacturing in the United States. And so a big degree of that is, hey, we're going to start exporting more to these foreign countries. Well, if we have a weaker currency, there's going to be greater demand for our goods because they're cheaper. And so, domestic manufacturing businesses can thrive to, some kind of greater extent because they are sending those goods internationally. I will say that with a caveat, though, is that if you are still sourcing the raw materials or the input goods from other countries, then it doesn't really help because those domestic businesses are having to pay more for the inputs for their goods that they're eventually going to send elsewhere. So it really comes into, sector by sector, industry level goods, because how much value are you adding to that good in final production? If it's just a cog, if you're making nuts and bolts, you're not adding a ton of value to that metal that's going into it. So if that metal is being sourced from another country, you're kind of at a disadvantage because, yes, your good is now in higher demand because your currency is weaker, but you're still having to pay up for those raw materials elsewhere. But if you're building something like a jumbo jet, of course, the raw materials are only, a fraction of the cost of what it takes to actually build that machine. And so you may end up with kind of a better benefit from a weaker currency. So it's going to depend on an industry by industry basis. But I think that's an interesting dynamic of that, unless you're sourcing everything from within the United States.
Well, that's why it works out so well for China, because they're the ones who are, manufacturing, from the ground up, pulling ore out of the ground, turning that into iron and steel, and then making an end-use component with it. So it works out very well for them, where someone like the United States, that might not be the case quite so much. And this is kind of where I want to go back to what I was talking about earlier with traditionally in economics, when you run, you have a strong currency, but you run a trade deficit, generally that should, in theory, weaken your currency to make your exports more, competitive on the world stage. And that'll help your manufacturing sector as well, because they have more markets to sell into. And I can see where the administration really values that manufacturing, which has been eroded by a strong dollar, not having that international market to sell into. But if we try and force it the other way to rebalance that, because we're still the world's global reserve currency, we'd have to force it back into equilibrium. And all of this takes a very long time to adjust. It's not an overnight thing where our domestic manufacturing is going to come back immediately in order to sell, out of the US. And so while domestic manufacturing would theoretically rebound under a weaker currency scenario, it's not going to happen overnight. And, the companies would have to reach larger scale through exports and a lot of time. Although that is slated as a pro to having a weaker currency in the long term.
Absolutely. And I think as a final note on maybe a benefit of a weaker currency, you mentioned the opposite side of it is that, if a stronger currency, you're going to be able to travel to other countries cheaper. Well, conversely, if you have a weaker currency, other countries can travel to you cheaper. So there's more demand for domestic tourism or international demand to travel to the United States. Say if the US had a weaker currency, that demand is going to ramp. But I really want to get back to what you were saying about manufacturing, because it leads us into the directionality of currency changes. So, maybe some concerns for dollar weakness if we're to head that direction, because I think it does bring up some challenges. I think the best FX picture in general is pretty stable exchange rates. But why don't we talk about some of the kind of interesting dynamics as far as if you are to have a weakening currency?
And that's another really interesting thing about the currency markets in general that you bring up is strong versus weak currencies is one thing, but then you add in directionality, and that really changes things because as time goes on, you can be impacted by that effect as well. And so, a sharp weakening in the dollar, you kind of mentioned this earlier, could bring up inflation because we don't have the domestic manufacturing here to accommodate for that yet. But all of the imports that we currently rely on get considerably more expensive. And so during a time when inflation is where it is, that's a real concern of it's not an overnight thing to prop up domestic manufacturing to give us, something to buy, and we'll still be importing these legacy goods from overseas.
Right. And I think, that's important to consider. Obviously, the Fed is very focused on inflation right now. We don't want to see that get out of hand, especially with tariffs, adding this whole new price dynamic onto everything. And I think even given where policy is at right now, I don't think it's going to lead to a sharply lower currency. There was that kind of shock factor initially, but unless the administration really actively worked to devalue the currency, which they haven't really talked about, the Trump administration is kind of mentioned, potentially having a slightly weaker currency in order to promote those exports. But I think really right now where policy stands, we're going to hold up as far as dollar strength goes.
And Bessent reiterated that. The Treasury Secretary, Scott Bessent, reiterated the strong dollar policy recently because people were asking about some of these comments that you take them at face value, out of context. It sounds like the administration might want a weaker currency, but when the Treasury Secretary is reaffirming the strong dollar policy, that's what we should be paying attention to. So, yeah.
And that's important because a lot of dollar strength, it plays into the dynamics of international investment. And internationally, investors want to know that if they're investing in the United States, at the very least, the FX rate is going to maintain its stability. Ideally for them, it's actually, the dollar strengthening because what they're getting when they buy US debt, whether that's a US Treasury or some other form of debt, or they're making some kind of equity investment, say in US stocks or something like that. Well, they have dollar exposure there. And if that values appreciates against their currency, they're getting more than even the strict return that came out of that investment. So, if they buy a Treasury bill or bond that's yielding, call it, 4%, but then there's a, 1 or 2% currency appreciation on top of that. Well, they're essentially returning, 5 to 6% instead of that 4% on a very, simple, relatively risk-free investment. So that's attractive for them. And what you don't want is a consistent weakening in the currency because then it does the opposite. So if you have a 1 to 2%, depreciation of the dollar, well, then all of a sudden those foreign investors who just bought that 4% treasury bond, now you're talking a 3 or 2% return on your investment, which makes a really big difference, especially if you're looking for very secure capital. So it really plays into the international dynamics. And I think maintaining strong currency status is really important so that we continue to get that investment in the United States.
Yeah. And we've kind of, thrown a lot out there and just kind of want to wrap it up. And we try to take this from the perspective of being neutral because, anything in economics can't be, if you have personal feelings one way or another, it's very easy to skew what it looks like. And so, like in anything in business, we're trying to approach this as neutral as possible from that regard. But, there's also kind of, for me, the biggest, takeaway, biggest thing that convinced me that a strong dollar is probably better than the US having a weaker one is that the current regime hasn't stopped the US economy from reaching incredible heights. Like we mentioned before, we're a quarter of the world's economy. And even if there are some cons to the situation, it hasn't, we've become a very wealthy country. We're doing very well on the global stage. And, I don't think it's tough to argue for a regime change when what has been going on has been working so well.
Absolutely. And I think really the most important part of it is stable foreign exchange rates. International markets get kind of wonky whenever FX rates are really shifting aggressively because you want to have certainty in your investment. You want to know what your return is going to look like. You want your own currency to maintain its value. And so I think the most important part is relative stability. We've seen international, especially emerging economies with huge currency fluctuations, and that's never good from an economic perspective. And I think, for the most part, the US dollar is going to maintain pretty stable stable dollar strength, stable FX, depending on the, economy that we're talking about exchanging with. But really having some surety, some stability in our foreign exchange rates, I think is really important.
Yeah, it'll be interesting to watch how everything plays out. I expect the U.S. government to stick to this strong dollar policy. There might be some moves that weaken it a little bit, but, being the global reserve currency has done positive things for us. And I don't expect us to totally abandon that concept and push for a weak currency anytime soon.
Absolutely. Well, I think we covered it pretty well. Of course, for our listeners, if anybody ever has any questions about specific currency dynamics, we're happy to try to give the best answer that we can. But Hunter, thanks for joining me again today.
Yeah, thanks, Victor.